Hi, everybody. Last chapter. We're going to talk about a couple of things from corporate taxation that sometimes give students a little bit of confusion. First thing is basis. What is it? Well, basis is both the value of the cash or property that a stockholder exchanges for stock and the value of that asset to the corporation. If the transferors, the people setting up the corporation, end up controlling 80% or more of the corporation, then this exchange of asset for stock is not taxable. Otherwise, it could be a taxable event. There are two cases in which gain may be recognized by the transferors. That's the people putting assets into the company. If shareholder contributes an asset subject to a liability, and the relief of the liability is greater than basis, then the gain is recognized and it'll be equal to the excess. Second, if cash or other property received, in other words, boot, and we talked about boot in the last chapter, triggers a gain equal to the lesser of the boot or received of the gain. So basis of the contributed property to the corporation, that's known as the inside basis, is equal to the basis in the hands of the shareholder, plus any gain that was recognized by the shareholder. The basis of the stock to the shareholder, so that's the outside basis, because remember, we're talking about somebody putting an asset into the corporation in return for shares of stock. So the basis for the stock to the shareholder is equal to the basis of the property contributed plus any gain recognized minus boot received. Unless the shareholder increases or decreases his or her proportionate ownership, outside basis generally does not change. So for an example, Arturo contributed land with a fair value of 100 grand, a basis of 40,000 to a newly formed corporation in exchange for 90% of the stock. His basis in the stock is not 100,000, it's 40,000. Objective number 3. So determining the determination of taxable income generally follows the rules from Chapter 6 associated with a trade or business. For corporations, however, there is no AGI. Capital gains and losses are netted. Net capital losses are not permitted. If a corporation has a net capital loss, it can carry it back 3 years and then forward 5, and then it disappears. Only offsets the net capital gains in the carry back or the carry forward. Charitable contributions are limited to 10% of taxable income before the charitable contributions, DRD, and carrybacks. The excess is carried forward. Contribution amount for ordinary income property, such as inventory, is limited to the basis. And for 20 and 21, the percentage limitation is increased from 10% to 25%. Now we're going to talk about something called dividends received deduction. These are dividends received from other domestic corporations. If the DRD is 50%, is the DRD or the dividend received deduction is 50% if the ownership of the corporation is less than 20%. 65% if it's equal to or greater than 20% but less than 80, and if it's equal or greater to 80, then the DRD is 100%. Organizational expenses and startup expenses, those are things connected with getting the corporation up and running, can be amortized and deducted over 880 months. The corporation, however, must make an affirmative election of this option. The tax liability of a corporation with a taxable income of $520,000 is, well, the tax rate is 21% since 2017, so the tax would be $109,200. In 2021, a corporation reported taxable income of $150,000, before charitable contributions. The corporation made a charitable contribution of $50,000. Its permitted deduction is only 25% of the income before the charitable contribution. So the income before the charitable contribution was $150,000. So they get to take 25% of that, which would be $37,500. Some items that are a positive adjustment added back from book income to taxable income: income tax expense per books, excess capital losses, disallowed current year charitable contributions, book depreciation in excess of tax depreciation. And we're going to see this come back again in the next slide as well. And 50% of meal expense not at a restaurant. Remember, business restaurant meals are fully deductible. Some items that are negative adjustment or subtracted from book income to taxable income: life insurance proceeds, tax exempt interest, tax depreciation in excess of book depreciation, and charitable contributions. Schedule M3 is a comprehensive book tax reconciliation for large corporations, and that those are corporations with total assets of 10 million or more. So completion of Schedule AL is required of all corporations. That's false. This is a schedule from the IRS that helps determine who has to file Schedule L. Schedule M1 reconciles book income to taxable income. That is true. And 3, a corporation's depreciation expense is lower on the financial statements than it is on the tax return. This would be difference would be a negative or positive item on Schedule 1. It would be a negative. Now, Subchapter S corporations are normal corporations that affirmatively elect to be taxed in a manner similar to a partnership. So the individuals related to the corporations would be taxed directly. File Form 1120S, and the returns are filed 15th day of the 3rd month after year end. There are 4 tests in order for a corporation to meet Subchapter S. It must be a domestic corporation. It has to have fewer than 100 shareholders, only one class of stock, and the shareholders must be U.S. citizens or resident aliens. Subchapter S corporations report taxable income and separately stated items. The separately stated items are similar to what's reported in a partnership. The Subchapter S corporation, as opposed to a C corp, does not pay tax. The shareholders pay tax on the income. Shareholder basis in a Subchapter S is determined similar to a partnership, except corporate debt does not affect the shareholder basis. Basis is increased by net income, separately stated positive items, capital contributions, and loans from the shareholder. Basis is decreased by net losses, separately stated negative items, and distributions from the corporation at fair market value. It may sound as if I'm repeating things from the text, but a lot of these chapters have things that you really need to be able to just go look up. You're not going to remember them all. Subchapter S distributions are not taxable to shareholders. Again, shareholders have already been taxed on the income because the income goes down directly to the shareholders of the S Corp. Similar to a partnership in that income is taxed and distributions are generally not. If Alyssa is a shareholder in a Subchapter S corporation, has a basis of $1,000 in her stock, the corporation gives her a $200 cash dividend. Is this dividend taxable to Alyssa? No, dividends are not taxable to shareholders. And that really covers the basic things from Chapter 15. So again, we've reached the end of the semester. I appreciate all the work that you've done. I congratulate all of you for having made it to the end, and good luck on the project. And again, I'm always available as usual if you need help.